Hello everyone, the Magnificent Seven, a group of high-performing, influential companies in the US stock market and the S&P 500, have led the majority of the gains of the last year and most of this year too for the S&P. In 2023 and the early part of 2024, the Mag 7 has returned massively past what the S&P 500 has. However, are any of these big names currently trading at fair or undervaluation right now? We're going to be answering that question today. We'll take a look through their growth opportunities, their historical metrics that make up these companies, and whether any of them are our buy right now. Finally, at the end, carrying out a discounted cash flow analysis on all of the Magnificent 7 stocks. So stick around for that. And as always, if you get something out of this video, then please feel free to leave a like on the video and consider subscribing to the channel. So which of these awesome companies are going to be taking a look at first? Well, we're going to try and do all of them. We'll be looking at these different sections and see if there are any clear winners or losers in each group. Now, forgive me if this is not 100% reliable, as I may have made mistakes along the way. But I wanted to compare the companies side by side in this format. So first off, let's cover their market cap. We have almost everyone above $1 trillion, with Apple at the highest at 3.42 trillion, which is just staggering in terms of its size. And then we've got Tesla, the smallest at $798 billion, arguably making Apple seem the most expensive company in the world. Then we cover their revenue growth, which I took from guidance given by the companies themselves and where that was missing from previous history of growth. Now we have NVIDIA in the lead here at 57%, which is just unprecedented, followed by Tesla at 30%, with Apple actually being at its lowest at 5%, but this may change with cycles of iPhones in the future. Then we look at their price to earnings. Now the lowest being Google at 23, which is actually quite good for a mega cap company and one in big tech. And then we've got the highest being Tesla at 64, which on its own looks very, very high. Now importantly, this is the first basic ratio for comparisons to be made. And Tesla is actually priced quite a bit higher than NVIDIA in just PE alone. Now EPS growth over the past 5 years. Now I took the averages and put them into the chart. We have NVIDIA winning this section, which is not much of a surprise if you ask anyone. It's at 81%, followed by Tesla, although theirs is only for the past 3 years because unfortunately they have a history of unprofitability in this area which stretches back quite far. And again, Apple is the slowest here at 17% over the past 5 years, mainly through buying back shares, I would say. Then we have their price to free cash flow with the operating cash flow in brackets. Now, as we can see, we've got Meta is the winner here, with Google a close second, I would have said. Now, meanwhile, NVIDIA, I would have said is just a very high overall, over 60, and Tesla is just probably not the best metric to value this company, put it that way. I'm not trying to bash these companies, by the way. I just wanted to show them in the simplest format and compare them to each other as best we can. And then we get on to the free cash flow and operating cash flow growth over the past 3 years. Now we have NVIDIA winning this one again, which is a no surprise, at 91% growth over the past 3 years. Now this is followed very closely by Amazon at 90% free cash flow growth over the past 3 years, which to me is very staggering and actually a bit more predictable than maybe NVIDIA's would be. And Apple came in lowest here again at 3% free cash flow growth and 3% operational cash flow growth over the past 3 years. Now, even though this may be due to iPhone cycles and other things, I would say this is a very slow metric overall for Apple. So altogether, in summary, from taking a look at these ratios, we can see some winners and losers here. First off, from looking at the fundamentals, we have NVIDIA is winning in 3 categories, basically all of the growth profits, which is to be expected, I would say, and shows how amazingly well they are doing. Now, Apple was one that looked the most expensive from just looking at these fundamentals. If we take a look at the highest market cap, the lowest revenue growth, the lowest EPS growth over the past 5 years, and the lowest free cash flow growth over the past 3 years. However, past performance doesn't necessarily mean this will be the case for the future. For either company, really. NVIDIA may see this growth rate slow down and drop inevitably as the company grows in size, and Apple may start growing more come the future. So this isn't set in stone, but it does give us a bit of a better idea of where we sit on the fundamentals side of things. Personally, I'd say that the free cash flow growth numbers are getting hit hard by capital expenditure for certain companies. Now, that's not always going to be the case. So for particularly the likes of Google and Amazon, I would say that they're still paying high capital expenditure, and that is impacting their free cash flow. Whilst Meta, Amazon and Microsoft actually look quite good all-rounders in this space on all these metrics, having faster growing profitability on the side of Amazon, if you ask me, in free cash flow and operating cash flow. And then we move along to the expectations for the future. Now, analysts expect all of these companies to grow over that 10% range in terms of EPS from 2024 to 2025. Now, here we have a clear winner again, and that's NVIDIA, at 30% expected EPS growth from analysts, which is just awesome, but this may be expected to slow down and is expected to slow down in the concurrent years after by a substantial margin. And then we have Tesla, which also expects good EPS growth, followed by Amazon. And again, the lowest of the category, we have Apple here being the lowest from analyst expectations at 11% EPS growth in 2025. And then we get on to the growth of the companies themselves. Now, we'll be looking for above 11.9% here, which is what the S&P 500 is expected to be growing in the next 5 years or so per annum. Now, here we get NVIDIA winning again at 52%, followed by a very impressive 31% for Amazon. Now, Tesla was the lowest here at 1.4%, which I thought was quite harsh towards Tesla. And analysts don't seem to expect much growth from this company over the next 5 years, which is a bit concerning. So from analysts, averaging out, I would have said that NVIDIA is the clear winner if they perform as expected by analysts. That was followed by Amazon based off both of these two metrics of analyst data. But I would say it actually depends whether you care and actually use analysts' expectations when valuing stocks. Personally, I don't consider them that helpful, and they're open to manipulation because often they have to make changes and expectations to stay relevant in financial markets as analysts. So I don't always take them into account when I'm valuing stocks. I like to make up my own mind. So now we get on to my own interpretation of the fundamentals. Now, this is mainly through historical metrics of the companies and carrying out a discounted cash flow analysis of the companies themselves. Now, I put emphasis on free cash flow growth and operating cash flow growth when doing my research, but that may not be what you as an investor want to prioritise. Now, I do this because I think it's the only solid way of attempting to predict the future free cash flows of a business and what I'm getting for my money. But if that's not how you want to look at it, I'm sorry, but these sort of metrics that I've put together and the valuations I've put together may not be for yourself. But use your own thought and make up your own mind. Amazon has a price to free cash flow which is historically quite a bit lower than the average. The average has sat closer to 67 times price to free cash flow. That's 67 years of free cash flow to get to the same amount you're paying for, and it currently sits at 40, which is still quite high for the majority of businesses. However, I would say that Amazon's price to free cash flow based off its future growth is not that bad and actually quite a positive for this company, I would say. And then we have their price to operating cash flow, which is sitting at an all-time low of around 10 years. So in the past 10 years, they have sat around about 27 times price to operating cash flow, a metric that is almost closely related to the share price, I would say, for Amazon in particular. And at the moment it's sitting at 18, which is near to a close time all-time low for them. So I'd say that's a really positive metric for Amazon in terms of valuation, because we're saying that the operating cash flow is growing quicker than the overall share price of Amazon, because when this metric goes down, we're basically saying the price has not changed, but the fundamentals have got better, particularly on operating cash flow. Meanwhile, Microsoft seems to have an above average price to operating and free cash flow based off the historical metrics of the last 10 years. We're seeing an expansion in the share price over what the fundamentals are currently delivering. That doesn't necessarily mean that the growth is not justifying that. So we have at the moment Microsoft sitting at a price to operating cash flow of 26, when the average in the past has sat at 20. And then we have a price to free cash flow of 41, when the average in the past over the past 10 years has sat at 28. When we consider the fact that Microsoft is not growing quicker than it has in the past, this historical metrics leads us down the path of thinking that Microsoft is slightly overvalued given the expansion of these two particular metrics. And then we've got Apple, which sits at historical highs for its price to operating cash flow and price to free cash flow. At the moment, they've got a 30 times price to operating cash flow, with the average in the past sitting closer to 17. And we've got a price to free cash flow of 33 times compared to the average of 19 over the past 10 years. So I would say this overall is quite bad for Apple. I would say that it signals overvaluation because the price is outpacing the fundamentals of operating and free cash flow. That is the free cash flow and operating cash flow they are producing right now. So when we consider and add on the fact that their free cash flow and operating cash flow growth has been historically quite low of late and in the future is not anticipated to rise much by analysts, we have to consider whether this multiple and the multiples in the future are justifiable. And when I look at this metric, I like to look at when Warren Buffett was buying this particular stock. Apple was bought by Warren Buffett down here in 2016. That's when Apple set out a price to operating cash flow of 7 times and a price to free cash flow around 8 to 9 times, which is just amazing when you consider the fact that this was amazing undervaluation, and this to me signals overvaluation. So maybe Mr. Warren Buffett is looking at this particular metric for Apple, and that's maybe why he's trimmed over 50% of his position in the past year. And then we have NVIDIA. NVIDIA's price to operating cash flow sits at 66, whilst its price to free cash flow sits at 69 times. Now those are very high metrics, but if we compare it to their 10-year average, they've sat at 56 times price to free cash flow and 48 times price to operating cash flow. So these metrics don't sit massively above what I would say the average is in the past 10 years. So whilst we've seen with Apple a continued margin expansion and the ratio continue to get worse, we see with NVIDIA the fundamentals are actually improving quite considerably compared to this average share price. And whilst this does signal a bit of slight overvaluation, it doesn't necessarily insinuate any sort of massive ratio outperformance for these two metrics. The operating and free cash flow are still growing massively, and that means that the price that we're paying for them is actually almost justifiable by the fundamentals, just from looking at this. Now there's a caveat with that, because I would say that NVIDIA is in an unprecedented cycle of growth. So I can't predict what it will likely be in the future. So you can almost justify any metric with a company that's growing this fast. So it's very difficult to say this will continue because I don't think anyone can predict the future. So I'm not the best person to talk about NVIDIA. I haven't done my due diligence with researching this particular company because I don't think I am in a comfortable way of predicting this company for the future. So whilst these fundamentals, to me, don't look massively overvalued, I would say they are slightly overvalued, and it could be the case that if this growth massively decelerates, then these metrics are hard to justify. Then we look into Google's historical metrics. Google has a price to operating cash flow at the moment sitting at 19, a price to free cash flow of 32, and a price to earnings sitting at over 22, closer to 23. And we can see the average price to earnings for Google has sat much higher at 29. Their price to free cash flow has sat below what it's currently at of 32 at 28, and they have a price to operating cash flow average over the past 10 years of 17, which is under what is current their price operating cash flow of 19. Now, that's quite interesting because we have a price to earnings which is signalling undervaluation, and a price to free cash flow and operating cash flow that sits slight overvaluation. So this is a stock that I would say is based on how you want to value it. If you put more value on their earnings growth than you do their price to operating cash flow and free cash flow, then this is a company that is very intriguing. What I would say is that a lot of these fundamentals and ratios are impacted by capital expenditure, which Google has said in the past is likely to increase a little bit, but may level off or even decrease as they stop overspending on AI. So I would say that over time, this metric will close down. We'll see that this high level of price to free cash flow, this blue line, will come closer to these levels. And when we see that closing of this line come closer together, a bit more like this, we will see that this stock looks slightly undervalued right now, I would say, based off looking at their sort of historical metrics. It's just whether you think their capital expenditure is going to continue to increase to the moon, or whether you think the fundamentals are going to catch up with that capital expenditure as it sort of goes down in the future, which I think it probably more than likely will. Then we have Meta, which has a price to operating cash flow of 19, and they have a price to free cash flow of 30, with a price to earnings of around 29. Now, when we compare this to the average over the past 10 years, they have an average price to earnings that sat a lot higher at 37, signaling a bit of undervaluation there. A price to free cash flow which sat at around the average of 30, so they've got almost exactly the same metric there. And then we've got a price to operating cash flow of 19, which is also fair value. So we've got two metrics signaling fair value and one metric essentially saying undervaluation. Personally, I would say that it's sitting on a fair level, Meta. I'd say the fundamentals have improved, but so has the share price considerably, and it's gone up quite a lot in the past year. So I would say this one seems to have a stock price that has matched the fundamentals in a fair and representative way, and at the moment I don't think it's signaling either over or undervaluation just from looking at the historical metrics of these particular ratios. Now we get on to Tesla, which I just don't think it's fair I go into in massive detail. I just don't see the profitability with this company, but others may disagree. It's currently trading around 4 times its average of 10-year free cash flow ratios. So when we've got a free cash flow that sits at 454 times, that's 454 years of free cash flow at the current rate to justify its current share price. That is massive. That's not even just overvaluation, that's just a massive number. And the average in the past has sat at 116 times price to free cash flow. So we're seeing a massive ratio here that is just unprecedented in my opinion. It signals massive overvaluation looking at both these metrics. The price to operating cash flow sits at 67 and the average has sat at 68. So if we're just considering the price to operating cash flow, that would signal more of a fair valuation maybe. But I can't really comment too much on this because it's not a company I'm massively interested in terms of the historical metrics. I would say free cash flow signals massive overvaluation, and price to operating cash flow sits at more fair valuation on a 10-year basis given the averages. Now we get on to discounted cash flow analysis. Now I tried to be conservative with these ones, and I used the metrics that made the most sense to me going forward. I'm sorry if you may disagree. There are some prices that I arrived at that you may disagree with, so please just take a look at it and take away what you want from me doing these DCFs, because some companies you may feel it's unjustifiable to use a DCF model and certain metrics maybe don't fit the company. But I just had to do them for all to give a good comparison as a baseline. So first off, we've got Amazon. Now obviously it's one I own, so maybe I'm biased on this one, but this is just my outlook for the company. If I say that the operating cash flow is going to grow by about 13%, which I don't think is even a high number, I would say it's fairly conservative for Amazon. This is a metric they've grown massively in the past year, over I think about 80%. So when we consider the fact their annual operating cash flow growth over the past 5 years has sat closer to 25%, then I don't think 13% growth over the next 5 years is that bad. So they've had a bit of a share outstanding growth rate of about 1%. Obviously, I've factored that in. And I've lowered the average price to operating cash flow down to a more realistic figure, which I think would be closer to around 20, other than what is currently the average over the past 5 years of 25. So I've tried to be conservative with Amazon and take my bias out of it, but we've still got a fair value here of $221, which is 19% upside for this particular stock and has a CAGR of around 14%. With the free cash flow, it would be very similar. Around about a 10% free cash flow growth over the next 5 years would see a CAGR of around about 14% as well. Then we have Microsoft. I put a fair value on this one around $367 per share. So that's around a 12% downside from the current valuation and would represent a CAGR sitting at about 7% for this particular stock. Now obviously that's underperforming the market, but I would say that the metric of free cash flow growth sitting around 13% is fair to actually maybe a little bit more on the positive side for Microsoft, mainly because over the past 5 years they've returned about 14%. Obviously they are much bigger now. I'd say they're growing to around 11 to 13% free cash flow going forward, but very predictably. Then we've got the shares outstanding. They've been buying back their shares. That's been factored in. They've got a dividend growth rate that sits over that 10%, close to about 15%. And the 5-year average was sitting at 12.53. That's been factored in. And we have a slight downgrade in terms of average price to free cash flow growth, which is sat closer to around 34 over the past 5 years. So I put it down to 30, mainly because I thought it was quite a high metric. But if we continue to do it on the 34, then we could say that it's sitting at fair value now. So even then, I would say it's still just matching the market and we're trying to beat the market. So I would have to say that for me, Microsoft is more a buy and fair value, sitting around $367 per share. Now we get on to Apple. So I got a fair value that sits at closer to around $183 per share and a CAGR that sits at about 5%. Now, unfortunately, that's quite a bit of downside I see for Apple based off this free cash flow analysis. Now, that's factored in quite a slow annual free cash flow growth rate over the next 5 years, sitting at 8%. Obviously, I thought that was quite positive for Apple, given the fact that it sits close to about 3% now. But they've been buying back their shares at an excessive rate. That's been factored in over the average of the past 5 years, sitting closer to about 3.5%. And they have a dividend growth rate that's quite low, sitting at about 5%. I gave them their average price to free cash flow over the past 5 years of 24. And I still got a fair value sitting at 183. So I still think that there's overvaluation with this particular stock. I don't think it's a buy right now. If I was being more conservative with these estimates, I would put a 5% growth rate in free cash flow and maybe a 20 average price to free cash flow. And we would get closer to 133 fair value. Now, I don't think that is actually realistically Apple's fair value. I see it closer to about 180. But with this growth rate being less than predictable with the cycles of iPhones, I don't think this necessarily is one to buy right now. And then we have NVIDIA, which I found a fair value for sitting at $107 per share, around an 18% downside, and a CAGR of about 5% for this one over the next 5 years, particularly on free cash flow analysis. Now, you can argue with this assessment because I think that's fair. The annual free cash flow growth over the past 5 years has sat closer to 80%. So you could say, well, it's not fair to justify a metric growth rate of 25%. But like I say, I want to be conservative with these estimates. If we was to say 80%, then we would say that it can continue to grow for the next 5 years 80%, then it's massively undervalued by over 400%. Now, I don't think that is really a realistic way of valuing this stock. So 25% annual free cash flow growth rate over the next 5 years is still exceptionally high for almost any company. So if they can do this, I would be very surprised. So that's pretty impressive. They've got dividend growth rate sitting at 20%. That's factored in. No real share repurchases, so they may start to do that, and that may affect this fair value. And I lowered their average price to free cash flow growth rate over the next 5 years to closer to about 30. Now you can play around with these two numbers and get all sorts of fair value. For me, I can't really justify the unpredictable nature of NVIDIA. So that's why I don't invest in the stock, and these may seem conservative to a NVIDIA investor. So this is just my assessment of it, and that's the fair value that I arrived at. But please do your own research, and obviously you can come to your own conclusions. This is just my take on NVIDIA's growth rate into the future of the next 5 years, which I think signals overvaluation in this particular metric. So for Google, I did a messing around with the free cash flow analysis. I did 15% in free cash flow growth over the next 5 years, based off an average of 17%. I think this is doable for Google, but maybe a bit on the positive side as well. We've got share repurchases, which is factored in here. Over the 5 years, they've repurchased quite a bit of shares, so down about 2.25%. I put a 10% growth rate in dividend. I think this is on the massive conservative side. I would imagine seeing close to about 15%. And then we've got a price to rate free ratio that I sat closer to about 25 over the average of 26. As I say, that free cash flow, price to free cash flow that we're seeing at the moment is quite high. And I think that will likely change as capital expenditure becomes less likely to impact this particular metric. That gives us a fair value of $175 per share, around an 8% upside to the current share price, and a CAGR of 11.83%, still outperforming the market right now. So I would say this signals slight undervaluation, and when I was buying this particular stock, I was buying around the $148 mark. Now, for me personally, I think Google is a great company, and this DCF is a fair one, but you could argue that it is more than slightly positive. So if we saw a bit more of an average price to free cash flow sort of rate of about 20, then we would say this fair value is closer to $141 per share. So whatever way you want to put it, I thought these were the best metrics to put in to get a fair value for Google. We come to Meta, which was one I had a play around with as well. And I added a 15% annual free cash flow growth over the next 5 years. Now, this may be a bit too conservative for the likes of Meta because its 5-year average has sat close to about 22%. but I'm anticipating that slowing down a little bit. They've also been repurchasing their shares, which we've factored in. I had a dividend growth rate of 10%, but this may be undervalued again and a bit more on the conservative side. Then also lowered their price ratio of price to free cash flow, bowed down more towards 22. This is something you could have left higher maybe, and obviously their overall return would have been a bit better. But that means we've got a fair value of Meta sitting around $601, around 2% of the upside, and a CAGR over the next 5 years, a bit line with the market of 10.62%. Now, this is just my take on it. Obviously, if we had an average price to free cash flow over the past 5 years that sat close towards more the average, then we would see massive undervaluation, a CAGR of about 13.45% and a fair value of $682. Now, to me, I think that's pricing in an awful lot. I would prefer to be on the conservative side, so this is my fair value for Meta. And then we got on to Tesla, which is just one that I think can't really be valued with a free cash flow model, being quite a poor metric for the company overall. I left it in because I wanted to try it, but at a 5% free cash flow growth over the next 5 years, which sits just above their average, I would say even with a free cash flow price to free cash flow sitting at close to 200, over the 186 times average, which I just think is an amazing metric that I don't think is justifiable at all, we still get a fair value that sits at closer to around $65 per share. A massive overvaluation of about 73% and a CAGR that is minus 15%. Now, I think that may be harsh towards Tesla. I don't want to bash any Tesla investors out there. I just don't really think this is the metric to value Tesla for maybe. But I left it in, and I've tried to be as fair with the valuations and growth rates as I could, with also being fair to actually valuing this company. So that's the price I arrived at with Tesla. So from looking at everything, I would say that Amazon is the only one out of the Magnificent 7 stocks which is a buy right now. We can see that that represents the most upside from our DCF valuation. Our historical metrics are also most aimed towards Amazon as well, but that may be my own bias because both these metrics are done by me. Analysts have more of a pro look at NVIDIA. They believe NVIDIA is going to grow better than Amazon in the future. But I would say that personally, Amazon's growth rate is more predictable and NVIDIA's is yet to be sustainable. So you may have your own conclusions. Now, these DCF models may represent my fair value, but don't represent your own. So please do your own research and consider whether this is something that maybe can inform your overall research and come to your own conclusions about what stocks to buy from the Magnificent 7. But thank you very much for watching. I do appreciate it. And as always, I'll see you in the next one.